Welcome back to the channel. Today we're diving deep into the world of dividend ETFs, with a special focus on SCHD, the Schwab U.S. Dividend Equity ETF. This ETF has consistently captured the attention of investors across social media, largely due to its reputation as a solid dividend play. But how does it really perform, and are there better alternatives you might consider? Let's break it down step by step, so you can see what SCHD is all about and where it fits in your portfolio. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. Let's start with the basics. SCHD, or the Schwab U.S. Dividend Equity ETF, currently manages about $72 billion in assets. It's widely recognized among dividend-focused investors, but over the last 12 months, the fund's performance has been underwhelming, with a modest gain of just 2%. This has left some investors scratching their heads. If we take a historical view, though, things look a little different. From 2016 through the end of 2021, SCHD moved almost in tandem with the S&P 500. That changed in 2022 when the market experienced a sharp sell-off. While many growth stocks faltered, dividend-focused ETFs like SCHD held up relatively well, outperforming the broader index during that downturn. Since late 2022, however, the market's rally, primarily fueled by technology and AI-driven companies, has left SCHD behind. The three-year return for the S&P 500 during this period is roughly 84%, compared to SCHD's 24%. This highlights the ETF's more conservative positioning, which prioritizes dividend stability over rapid growth. So, what exactly goes into SCHD? The ETF follows an annual reconstitution process, where an algorithm selects the 100 stocks that will make up the portfolio for the next year. This happens each spring around March. The selection criteria are quite specific. Eligible companies must have paid dividends for at least 10 consecutive years. They also need a minimum market capitalization of $500 million. Once this pool is established, stocks are ranked by dividend yield, but that's not all. The fund also considers cash flow relative to debt, return on equity, and the 5-year dividend growth rate. The result is a curated mix of companies that not only offer regular dividends, but typically have healthy balance sheets and stable growth. Looking at SCHD's sector distribution, the largest allocation is in energy, followed by consumer staples and healthcare. Technology, interestingly, makes up only about 10% of the fund. This allocation explains recent performance. Over the past year, energy and consumer staples, the top sectors in SCHD, were among the worst performers in the S&P 500, rising just 2.5%. Meanwhile, tech-heavy growth stocks led the market, which is why SCHD lagged behind. SCHD's top holdings include household names like Merck, Cisco, Amgen, Bristol-Myers, AbbVie, Coca-Cola, PepsiCo, Lockheed Martin, ConocoPhillips, and Chevron. These are reliable, dividend-paying companies, but they lack exposure to high-growth sectors like AI and major tech, which have driven market gains in recent years. That said, SCHD shines when it comes to dividend metrics. The ETF currently offers a yield close to 4%, a 5-year dividend growth rate near 10%, and 14 consecutive years of dividend increases. For dividend investors seeking a blend of yield and growth, SCHD provides a strong, steady option, especially as a stabilizer for portfolios heavy in tech or growth stocks. If you're considering other options, the first ETF to explore is VIG, the Vanguard Dividend Appreciation ETF. True to its name, VIG focuses on companies with a long history of increasing dividends, rather than just paying them consistently. VIG holds roughly $120 billion in assets, making it slightly larger than SCHD. Over the past year, VIG has gained 12.6%, significantly outperforming SCHD's flat returns. Why? Its portfolio leans more toward technology, which has driven market gains. In terms of sector allocation, technology accounts for nearly 30% of VIG, followed by financials at 21% and healthcare at 17%. Its top holdings include Broadcom, Microsoft, Apple, JP Morgan, Eli Lilly, Visa, ExxonMobil, Johnson & Johnson, Walmart, and MasterCard. Dividend-wise, VIG offers a yield of 1.6% with nearly 10% dividend growth over 5 years and 11 consecutive years of dividend increases. While the yield is lower than SCHD, the potential for capital appreciation is stronger, making it a compelling option for long-term dividend growth investors. Next up is DGRO, the iShares Core Dividend Growth ETF. DGRO is smaller than both SCHD and VIG, managing around $36 billion in assets. Its focus is on consistent dividend-paying companies that combine stability with growth potential. DGRO has performed very well over the past year, climbing 13.5%. It's a balanced option, blending characteristics from both SCHD and VIG. Sector exposure is slightly heavier in financials, just over 20%, followed by technology and healthcare. Top holdings include Johnson & Johnson, Apple, JP Morgan, ExxonMobil, AbbVie, Microsoft, Broadcom, Merck, Procter & Gamble, and United Health. DGRO holds 4 out of 5 positions, with the top 10 accounting for 27% of the fund. The dividend yield is around 2.1%, with a 5-year growth rate of 7% and 11 consecutive years of dividend growth, making it a solid middle ground between high-yield SCHD and growth-leaning VIG. Finally, there's DEVO, the Amplify Enhanced Dividend Income ETF. DEVO takes a slightly different approach, combining blue-chip dividend-paying stocks with a covered call option strategy to enhance monthly income. With $6 billion in assets under management and less than 10 years on the market, DEVO is relatively new but appealing for income-focused investors. Its top holdings include Raytheon, American Express, IBM, Goldman Sachs, Microsoft, Caterpillar, JP Morgan, Visa, CME Group, and Apple. DEVO holds just 30 positions, with the top 10 making up half the fund. DEVO is designed for investors seeking consistent monthly income rather than long-term dividend growth. For retirees or those looking for a hands-off approach to enhanced yield, DEVO can be an excellent option. To recap, SCHD remains a strong dividend ETF, providing solid income and consistent growth. It's not designed to chase high-flying tech gains, but it's an excellent stabilizer for portfolios heavy in growth or tech stocks. If you're looking for alternatives, VIG offers long-term dividend growth with a stronger tech tilt, DGRO blends yield and growth for a balanced approach, and DEVO provides an enhanced income strategy through covered calls. Ultimately, the best dividend ETF for you depends on your goals. Whether that's maximizing yield, focusing on dividend growth, or generating consistent income. Understanding how each ETF is constructed helps you make a more informed decision and align your investments with your financial strategy. Thanks for watching. If you found this helpful, don't forget to like, subscribe, and hit the bell so you don't